All right, thanks for your patience. We'll make a start, everybody. So welcome to our webinar on maximising your mortgage savings. Thanks everyone for joining us today. My name's Andy Whelan. I'm the General Manager of AP Group, and we're also joined today by one of our senior brokers, Matt Edginton. Matt, how are you today?
Very well, thanks, Andy, and hello to all that have joined.
Fantastic. Okay, so before we get into the content, I would like to acknowledge the traditional owners of the lands on which we conduct the webinar today, and we would like to pay our respects to their elders, past and present. Now, at the conclusion of the webinar, we'll be taking the time to answer any questions that come through. Best thing to do is when you've got a question that pops up, feed it through the Q&A function on the menu. We'll save them all up and we'll answer as many as we can at the end of the session. And if we do run out of time to address your specific question, we'll reach out to you directly and get a response for you. So just to repeat that, questions via the Q&A function, and we'll answer as many of those as we can at the end. So welcome again to our webinar on maximising your mortgage savings. I'll pass now to you, Matt. Can you take us through the agenda for what we've got in store today?
Certainly. So for the agenda today, we're covering off three topics. The first will be the loyalty tax and what that is. We'll jump into pros and cons of fixed and variable rate products, and then we'll give you our key takeaways from the webinar as well.
Fantastic. So thanks, Matt. Loyalty tax is a relatively new term. I think it'll be new for most. Certainly sounds ominous. Can you tell us what is the loyalty tax?
Yeah, certainly. So look, in effect, the loyalty tax is when an existing borrower's interest rate exceeds that of what a new customer would get, or new to bank customer would get. Now, the loyalty tax is actually quite variable. At the moment, it's sitting at 0.07% for owner-occupied loans and 0.11% for investor loans. And just to give you an idea of how dynamic the loyalty tax is, it was at a high of 0.51% in late 2022. So as you can see, a wide range of margins there.
Yeah, absolutely. And so just to kind of sum that up again, given it's a new concept for most, essentially what you've got is same loan, same bank, new customers are actually paying across the market less than existing customers. So the offers that are put up for new customers to entice them in the door means that they're paying less than existing loyal customers. And so that's what this loyalty tax is. And as Matt rightly mentioned, it's 0.07 for owner-occupied loans at the moment, or 0.11% for investor. Has been as high as 0.5%. If you look at a chart over time, it does vary. And I guess when we're talking sort of small percentages like that, it may not sound like much, but in practical application, it can have really meaningful impacts for customers. So Matt, do you want to just take us through what do those percentages actually mean for customers in terms of what it can cost them?
Yeah, of course. We've got two examples here, and we're running off the average Aussie mortgage of $635,000. In the first example, we've got the current loyalty tax margin. So as you can see, the difference for an existing customer, they would be paying on average around $15,000 more than a new customer based on that margin. So again, it doesn't sound like a lot at 0.07 to 0.11, but as you can see over the life of the loan, it really does add up. And again, we obviously touched on how variable the loyalty tax actually is. And just to give you an idea of what it was at the peak back in late 2022, you can see that 0.51% over the life of the loan of 30 years. It's closer to 100 grand. So, you know, we're not talking a couple pennies there.
Yeah, certainly it's big numbers, and I kind of like looking at this from a slightly different perspective. If someone put to a rational-minded person, would you pay $15,000 over the life of your loan for the privilege of staying with your existing bank? Or worse still, you know, when we take the loyalty tax at its peak, would you pay $97,000 for the privilege of staying with your bank over the life of your loan? And certainly most rational-minded people would say no to that question. But thankfully, it's not mandatory that you have to pay the loyalty tax. There are ways to avoid it. So Matt, do you want to just take us through what your top tips are for how you can avoid the loyalty tax?
Yeah, of course. We've got three key tips here. The first one ties in closely with tip 2 and 3, but the first and most important one is consult a finance broker, whether you've got an existing relationship or you're looking for a new one. it's really important to seek out professional advice in the area. Again, a finance broker such as ourselves is going to have access to the entire market as opposed to just, a single lender and what they're offering. And to jump into points 2 and 3 there, so they'll be able to help you out with both of these. The first is doing regular reviews. So at AP Group, we typically do a review every 6 months for our clients. If the market demands, we'll actually do it more frequently. And, obviously over the last 2 years, there's been a fair bit of change. So we have jumped in and helped out with the reviews when required. And then lastly, that tip number 3, be willing to switch when your current lender doesn't come to the table with a competitive interest rate. And, it's not to say that we actively promote going and refinancing at every review, but, in some cases it may be necessary if the benefit is high enough, because as we touched on before, those small margins do add up to a lot over the life of a loan. So I think they're probably 3 really important tips for people to take away.
Yeah, thanks, Matt. I think that's pretty well summed up. And I guess just to kind of put my take on it, it's all about making sure that you get the best possible rate on the way in the door as a new customer, and then working with your existing bank to respond to changes in the market as they happen to make sure your rate remains competitive throughout the life of your loan. And if you can do those things remaining with your existing bank, then fantastic. That's always the starting point. Thirdly, as Matt mentioned, being willing to switch. That tool is there in the kit bag for when it makes sense for you to do it and you can't get the benefits with your existing lender. So good set of tips there. Thank you, Matt. Now, guys, we have had a bunch of questions come through the Q&A, which we appreciate. Please do keep firing those through. We'll get to as many as we can at the end of the session. So yeah, just to reiterate, through the Q&A function when you've got a question that pops up. Brilliant. Okay, so we'll keep moving through the content. We're going to jump into summary of fixed and variable rates. Back to you, Matt.
Yeah, so just to give an overview of what the fixed rates are. So in effect, a fixed rate locks in an interest rate for a period of time. Typically, that's going to be between 1 and 5 years. Main thing there is it's going to ensure stable repayments over the period of time. At the end of that fixed rate, it'll typically revert to a variable rate unless you actively seek to go into another fixed term at the conclusion of that. And then probably the last thing, and more so something just to flag, and we'll touch on a little bit more in the following slides, but with a fixed rate, although you get that stability, you're going to incur break costs if you choose to switch or refinance, during that term. So just something to flag there, and we'll get a little bit more into it in the next slide. So we'll just cover off a couple of the pros and cons. There's a suite of each. A couple of the benefits, and touch on this one briefly in the last slide: consistent repayments. So, being able to know exactly what your repayment is for a period of time certainly suits some of our customers, and probably one of the key pros for having a fixed rate is that, whether it be 1, 2, or 3, 5 years, you know what you're going to be getting every month. So that's definitely a key benefit there. It can protect against rate hikes, which, over the last 2 years, I think we've had close to 13 rate hikes. So certainly something that would be at the front of everyone's mind, given what's gone on in the market in the last couple of years. And then lastly, it is ideal for long-term planning. So if you've got a holiday or something else that's planned and coming up in the next couple of years, sometimes just having that fixed repayment and knowing what's coming in each month by way of repayment can be really handy, and just ensures that, you can budget around it. And then some of the considerations, again, one that I touched on in the last slide was break fees may actually be payable if you leave the term early. Now, not to say that a lender's going to give you a kick on the way out. They can only charge you the economical cost to them at the time, but the cost can be quite high. So it's something that, you can have a chat to your bank or your finance broker about, and, they can get an estimate of what those break costs will be if you are planning on leaving during the fixed period. Another consideration is less flexibility. So, there are limitations to how much extra you can pay off your loan during the term. And additionally, you may be restricted to what loan features or popular loan features such as offset and redraw that might come into play as well with a variable rate product, for instance. And then just lastly, sort of the inverse of the rates going up, that if the rates do go down, then you're going to miss out on those rate cuts until such time that you come off your fixed term. and then we'll just keep rolling through to the variable rate ones. So a bit of an overview here. And again, a variable rate is as it sounds, or is as it says it is. It's going to fluctuate with the markets. In effect, your repayments will go up and down in line with where the interest rates are sitting at the time. Probably the key one to take away from variable rates is you've got a lot of flexibility with it. So if you are someone that likes to tip extra money into the loan when you've got it, then that makes a lot of sense. There's no limitations in that aspect. And you also have full access to loan features such as offset and redraw. So we can touch a little bit more on them in the next slide. So again, suite of benefits here and a couple of cons with the variable rate products. The first one is that savings opportunity with offset and redraw, which again, I mentioned a little bit both in the fixed and variable slides. But in effect, if you have a $500,000 loan and you've got $50,000 in offset, the interest is going to get charged on the balance of $450,000. So again, obviously over the life of the loan, that'll save on your interest costs. And a redraw works in a very similar way in that whatever you've got in the redraw will mean that you're getting charged interest on the balance, less that amount. So you can sort of use that same example, 500K in the as your loan, 50K in redraw, you'll be getting charged interest on the 450K. The second one there is, unlike a fixed rate product, there are no exit costs. I've put a little asterisk there. There are some nominal fees to refinancing, but there's certainly no break costs or large surprises that you may encounter through the refinancing process. And again, another one that I sort of briefly touched on, but repayment flexibility. So again, if you're someone that likes to make those extra repayments when you've got a bit of extra cash or whatever it may be, and tip that extra money in to bring the loan balance down, then a variable rate product would probably be the one for you. You're able to make those extra repayments without limitations. And then lastly, you will benefit if the rates go down. And again, probably not something we've seen in the last couple of years, or we haven't seen. We've seen a lot of the rates going up, but something to consider moving forward anyway. And then the last one, just to go through some of those considerations. So the inverse of the rates going down, again, rates going up will mean your repayments go up as well. And ultimately that's going to lead to a bit of budgeting uncertainty. So that variability in repayment can mean that, that changes month to month. So it's just something to factor in.
Fantastic. Thanks, Matt. That's a pretty nice little summary there. Just take a moment to acknowledge, I think most people on the call would have some idea of what variable and fixed rates are. But what we wanted to do today is, I guess, give the explanation for those who weren't familiar, which I'm sure there'll be some, but also just to flag that these two rates and some of the product features that sit within them are essentially just tools for you to use as customers to be able to get the best possible outcome. So just to give you a quick example of what that might look like, at the moment we're seeing for the first time in a long time that fixed rates for most banks are sitting below what the variable rates are, and that's quite the opposite to what we've seen over the past couple of years, as Matt alluded to. All those rate rises that have come through the system. So while fixed rates are now sitting lower than the variable rate, that presents an opportunity. Perhaps if you were a customer who needed some relief from those higher rates, you could capitalise on the fixed rate being lower for a portion or even all of your loan, if that made sense to you. But yeah, essentially, I guess the message is, these rates, these products and the product features are opportunities for you. They do move over time in terms of the pricing and rates of them. Having someone in your corner to help you capitalise on the opportunities when those opportunities present is really what we wanted to leave you with today by way of message. All right, so we'll keep moving through the content now, and we'll jump into some key takeaways. But I'll pass back to you to do this. But I do notice we have had quite a few people join through the session. So and I know you will get to this in your takeaways, no doubt. But when you touch on the loyalty tax, it might be worth just very quickly defining what that is again, just so those late joiners do get you get your take on what that loyalty tax is.
Yeah, absolutely. So we've got 4 key takeaways from the webinar. The first one is consult your finance broker. I think the market's sitting at about 75% of new mortgages in the market are done by mortgage brokers. So it's just showing there's a big sway towards using them. I think that ultimately comes down to a couple of things. In the long term, it's going to save you money, whether it be on the loyalty tax or product features, whatever it is. They're also there to help you decide whether a fixed or variable rate is right for you, but really important to consult an expert in the area and someone that's got access to the entire market. The second one, and probably one of the most important ones, is rate matters. So, we touched on the loyalty tax there, and just to give a bit of a recap, the loyalty tax is effectively when an existing customer or an existing customer's rate is higher than that of what a new to bank customer would have. So the current owner occupied loyalty tax is about 0.07%, and for investor 0.11%. And we did show a couple of examples, which some of the late entries to the webinar will be able to go back and review afterwards when they get the recording. But basically what you're looking at is on the current loyalty tax margins, on average, you'd be paying about 15K more than that of a new to bank customer. And again, we touched on it, but the loyalty tax is dynamic, and at its peak, it was at 0.51%. So if you take the average Aussie mortgage over 30 years, that would be closer to about 100K. So smaller margins, but we're still talking quite a bit of money when you look at it over the life of the loan. So really important to do that. And that leads me into point number 3, which is regularly check in throughout the life of your loan. So your finance broker is going to be able to help you with this, but effectively making sure you're doing those reviews. And again, to any latecomers to the webinar, at AP Group, we do a review every 6 months. But when the market demands, we'll do it more frequently than that. But again, typically your finance broker will be able to go to the current lender and just make sure that rate remains in market. So making sure that you're doing those regular reviews is really important to save your money in the long run. And then lastly, and again, I know we touched on fixed and variable rates separately, but you can consider using a combination of both fixed and variable rate products. It's called a split loan. So effectively, what we typically see is people fix a larger portion of their loan and they'll have a smaller portion of variable. And what that means is they'll have access to sort of the best of both worlds. They'll have that budgeting certainty, and then on the variable split, they'll be able to use product features such as offset. They'll be able to make those extra payments if they've got, the cash to do so. And, again, like I said, that's a good balance to have, and something that we've been seeing more questions asked in the area, as Andy touched on a bit earlier. For the first time in a long time, fixed rates are actually lower than variable rates. So again, what we're seeing is people coming in and doing that split rate product. So yeah, something to consider.
Fantastic. So great set of takeaways. Thanks, Matt. I guess just to circle back to your first point, when we say consult your finance broker, I guess it's just an acknowledgement that it's not a bank's job to get you the lowest possible rate. A bank will try to give you good service and give you good access to products, but it's not their job to search the market and get you the best possible rate that you can get. And that's where we differ from a bank. So we work for you to get the best outcome for you. So ultimately you could end up with the same bank potentially, but hopefully on a lower rate and better repayment structure. So that's really what it's all about. We've had a stack of questions come through, so let's dive into some of those, and we'll get to as many as we can. So first one that we'll pick up, Matt. So you mentioned using a combination of fixed and variable rates. Do you still get access to offset and redraw if you use a combination?
Yeah, definitely. So briefly touched on it when we were on our last slide, but basically, if you've got that variable split, you have access to all of the benefits that come with a variable rate product, such as offset, redraw, making extra payments, and then obviously, the fix, you've got that budgeting certainty.
Yeah, terrific. And I guess probably the only thing I'd add to that is that if you do have either all fixed rate or just a combination of fixed and variable rate, you do lose that portability benefit, because even if you're part fixed, that makes it more difficult to switch to another lender without incurring those break costs. So that's just one thing to be aware of. But yeah, I guess the key point to address that question is, yes, you do get access to offset and redraw if you're using a combination of fixed and variable rates. So thanks for that, Matt. Second question here, what are the fees or costs associated with using a mortgage broker?
Yeah, so the great part about using a mortgage broker is there are no costs. So we're paid by the banks. And in fact, during an application process, we always disclose exactly what this is. So we'll explicitly outline exactly how much and what we're getting paid. But yeah, the client does not incur that. So whether you're doing a refinance, internal product switch, or just one of those 6 monthly reviews, there's no cost involved for using a mortgage broker. So all really beneficial.
Terrific. Thanks, Matt. I've got another good question here, which I might pick up. So we've talked about the loyalty tax and I guess the costs of loyalty. Got a question here. Are there any benefits for being loyal? And I guess I'll probably answer that question by saying that both Matt and I are advocates for loyalty to your existing lender. I guess the key thing is two things. It's one, making sure that that relationship gets managed right the way from inception all the way to when the loan is finally paid out, to make sure that you're getting the best possible rate that you can with that existing lender. And then, as we mentioned before, worst case, if you can't get the outcome with your existing lender, then break glass in case of emergency and consider switching. But yeah, the second benefit I'd say for loyalty with your existing lender is, and this particularly applies if you've got a personal banker, when you've got someone who knows your situation and knows your history, that can make the next project, whether that's buying an investment property or whatever it might look like, can make that an easier path. So that's worth considering as well. I guess, yeah, just to reiterate, the key thing is you want to make sure that you're going to be on the best possible rates and repayments. And ideally, we can do that with your existing bank. Okay, it's got another couple of questions I'd love to rattle through. Got a really good one here on offset. Matt, can you tell us how much of a difference offset makes?
Yeah, absolutely. So as we touched on before, if you've got a 500K loan and you've got $50,000 sitting in an offset account, you're all getting charged interest on the balance, so $450,000. And using that example, effectively, how you can look at it is that your interest cost will be 10% less than if you didn't have that money sitting in offset.
Yeah, terrific. It's well explained. Thank you. Another one for you, Matt. And I think you've covered this partially in the content, but how often do you recommend reviewing rates, and what's involved in that process?
Yeah, so look, we do ours every 6 months, and typically there's very little requirements from the client side. So we can actually hop in and do it for our clients, which quite often we'll do. And, again, sometimes we may need to touch base with the client for a bit of information, but it's rare. So for those regular reviews, it's pretty hands off for a client.
Yeah, terrific. And I think, Matt mentioned every 6 months, which makes sense as a baseline. We also mentioned those 13 rate rises that we've had over the last few years. During that period of turbulence, if you like, or market movement, we were doing that much more regularly because it made sense to do it, and we were able to get some benefits for customers more frequently. In the last sort of 12 months or so, we've been in a period of relative stability for rates. So, every 6 months, is not a bad baseline for times like these, but yeah, it's about responding to the market conditions and capitalizing on the opportunities when they arise. I think we've got time for one more. Barriers to switching. Do you want to, I guess, just give us a quick little summary on what the barriers are to switching banks?
Yeah, absolutely. Look, I think probably the biggest one, and well, there's a couple, but if you're on a fixed rate, the biggest barrier is going to be that break costs. Outside of that, most of the time switching is pretty straightforward. There is time and a bit of work involved in it. There's the document collection phase, which can be pretty hands-on for customers, and just making sure that getting all of that is really important, or getting it all correct is really important. And again, that's why touching base with a finance broker is super important, because in most cases I know we do anyway, guide you through the process. But yeah, in terms of blocks there, probably if you're on a fixed rate, that's going to be a block. Aside from that, sometimes the market can dictate it. I think at the moment, given how high rates are, we're seeing that servicing or your borrowing, people's borrowing capacity can be a bit of an issue. So, fingers crossed we could get a bit of a reprieve next year for interest rates, and, servicing becomes a little bit more favorable again. So, I think they're probably the two big ones though. And in fact, I'd probably go as far as saying is that servicing piece in the current market would be the biggest blocker at the moment.
Yeah, terrific. I think, that's well answered. I think that the barriers to switching are certainly not insurmountable, but there's a bit of effort there, and that's why we always start with trying to get the best possible price with your existing lender for you. So thanks for answering all those questions, Matt. They're all very well answered. Now, would just like to close the webinar so we can all get you out of here on time. So firstly, big thank you for everyone coming along today, and thanks for your engagement and questions throughout the webinar. We really appreciate your attendance. In terms of what you can expect from here, so everyone will receive via email a recording of the webinar, and you'll also receive a short 1-minute survey. We'd greatly appreciate it if you could take the time to respond to that survey. It's what helps us keep these webinars relevant and most useful for you. So keep an eye out for that email, and we'd appreciate your response when it lands. Finally, you can get this bunch more resources on our website. So if you go to apgroup.com.au and jump into the news section, you'll find a whole host of articles and webinars and useful stuff there to explore. And then lastly, of course, you've got Matt and my details there on the screen. We're very happy to help with any queries that you might have, so do feel free to get in touch with us. Thanks again for your attendance. Thank you, Matt, for taking us through the content today, and wishing you all a great afternoon. Thanks, guys.
Thanks, everyone. Have a good afternoon.